Europe's recent shift away from U.S. natural gas to Canadian energy supplies is sending shockwaves through the global energy market, posing significant questions about the future of U.S. exports and their economic ramifications. This dramatic change isn't just about gas, it's about a complete reconfiguration of energy alliances, market dynamics, and geopolitical power. The catalyst for this transformation can be traced back to the war in Ukraine. When Russia's gas supply to Europe was severely disrupted due to the EU's sanctions, Europe found itself in an unprecedented energy crisis. Initially, the U.S. appeared as a reliable lifeline, sending large quantities of liquefied natural gas, LNG, to Europe, helping the region survive a particularly harsh winter. The U.S. energy sector seemed to have saved the day. However, this relief came at a steep price. U.S. gas prices were far higher than global market rates, causing European governments and businesses to realize they were paying a premium. The cost of U.S. LNG was unsustainable, and further concerns grew about Washington's erratic trade policies. With each shift in administration came a new energy policy, creating an unreliable foundation for Europe's long-term energy security. The U.S. began to be seen less as a stable ally and more as a strategic actor using energy exports as a political tool. This, combined with the rising costs of LNG, pushed Europe to search for alternatives. Canada, with its abundance of natural resources, became an obvious choice. The country is rich in oil, gas, and critical minerals like lithium and cobalt, essential for the electric vehicle, EV, revolution that Europe is heavily investing in. What made Canada stand out wasn't just its energy resources, but its stable and predictable trade relations with Europe. Unlike the U.S., where policies change dramatically with each new administration, Canada has maintained consistent and long-term cooperative economic ties with Europe. Furthermore, Canada's commitment to clean energy, solar, wind, and hydroelectric power, aligns perfectly with Europe's green energy goals. While the U.S. is still heavily dependent on fossil fuels, Canada is already transitioning to a more sustainable energy system, making it a more attractive partner for the EU. This pivot to Canada is not just a blow to the U.S.'s energy dominance, it's a serious economic setback. The EU was once the largest buyer of U.S. LNG, and with Europe turning to Canada, the U.S. stands to lose billions of dollars in annual revenue. The U.S. energy sector's reliance on foreign markets has now been called into question, and its influence over Europe is at risk. Beyond energy, this shift also impacts the U.S. auto industry. Canada's ability to supply critical minerals for EV battery production further entrenches its role as a key partner in Europe's clean energy future. Meanwhile, the U.S.'s environmental regulations, which hinder its ability to mine these essential materials, make it less competitive in this market. The geopolitical implications of this shift are profound. The U.S. has long used energy exports as a tool for exerting influence over its allies. If Europe can find a reliable, politically neutral alternative in Canada, it weakens the U.S.'s position in global negotiations, reducing its leverage in international affairs. This could have cascading effects on U.S. foreign policy, and Washington faces a major challenge in reclaiming its influence. As tensions grow between the U.S. and Canada, the two countries are now locked in a trade war that could reshape North American and global economic landscapes. The U.S. recently imposed tariffs on Canadian imports, including energy products, while Canada retaliated with tariffs of its own. This trade war, however, isn't limited to just tariffs on consumer goods. It has a broader focus on energy. Canada is already pivoting its energy exports toward Asia, particularly China, to reduce its dependence on the U.S. The expansion of the Trans Mountain Pipeline, designed to increase oil exports to China, Japan, and South Korea, is a clear signal that Canada is diversifying its energy markets. This is a strategic move to minimize risks and gain greater economic opportunities. China, with its massive energy demand, has already become a crucial partner for Canada's oil, and the two nations are building stronger economic ties. If this trend continues, Canada could further reduce its reliance on the U.S., which would have profound implications for the global energy market. But what would happen if the U.S. suddenly lost its access to Canadian energy supplies? The consequences could be disastrous. The U.S. imports over 6 million barrels of oil per day, with nearly 67% of that coming from Canada. If Canada decided to cut off or reduce oil exports, it would send gas prices soaring in the U.S., especially in the Midwest, where refineries are dependent on Canadian heavy crude. This would not only drive up fuel prices but also increase production costs across the board, from transportation to food and consumer goods. The price of everything would rise, potentially pushing the U.S. economy into a severe recession. U.S. refineries aren't equipped to handle other types of crude, and if they lose access to Canadian oil, many could face operational shutdowns, leading to a massive economic ripple effect. This energy crisis could benefit certain players, however. Big oil corporations like ExxonMobil and Chevron may look to ramp up shale oil production, but it won't happen overnight. The U.S. would face significant challenges in replacing Canadian heavy crude, and even if shale production increases, it will require massive investment and could face environmental opposition. Meanwhile, OPEC, Russia, and China could seize this opportunity to further manipulate global oil prices and expand their influence over the energy market. So how will the U.S. respond to these growing tensions? The Trump administration is currently faced with a tough dilemma. Continue the trade war with Canada or negotiate a new deal that benefits both countries. If the U.S. continues its tariffs on Canadian imports, Canada may retaliate by cutting off its oil and electricity exports, leading to surging energy prices and destabilizing the U.S. economy. Alternatively, the U.S. could negotiate a new energy deal with Canada to stabilize relations and protect its interests. Another option is to increase domestic oil production to reduce reliance on Canada. But this approach comes with environmental and regulatory hurdles that could take years to overcome. Canada, however, is not just sitting back and waiting for the U.S. to make a move. In response to the tariffs, Canada has launched a boycott campaign, urging its citizens to support domestic goods instead of American imports. Canadian provinces like Quebec and Nova Scotia have already removed American-made alcohol from store shelves as a direct act of resistance against U.S. policies. This economic protest highlights Canada's resolve to protect its sovereignty and stand up to U.S. tariffs. The implications of this trade war go beyond energy and raw materials. Major U.S. manufacturers, particularly automakers like General Motors and Ford, rely on Canadian raw materials for production. If the trade war continues, production costs will rise, potentially pushing U.S. manufacturing to the brink. Similarly, tech companies like Apple and Tesla will face higher costs for components sourced from Canada, which could reduce their competitive edge. Even small manufacturers that depend on Canadian raw materials might be forced to shut down or lay off workers due to rising production costs. The U.S. economy, already under pressure from inflation, could face further challenges if these trade tensions escalate. The stock market is likely to suffer, as investors will grow concerned about the long-term effects of a trade war with Canada. The tourism industry, too, could be hit hard, as Canadian tourists are a major source of revenue for the U.S., especially in states like Florida, California, and Texas. If Canadians reduce their travel and spending on American goods, the U.S. could lose billions in annual revenue, further exacerbating economic instability. This trade war and energy standoff are rapidly evolving into a global crisis. The relationship between the U.S. and Canada has always been one of economic cooperation, but now it's on the verge of becoming a battle for control over the energy sector. The U.S. risks losing access to its crucial energy supplies, while Canada is strategically diversifying its markets and securing its economic future. This conflict is not just about two countries. It's about the future of global trade, energy markets, and international diplomacy. The outcome will determine how both nations navigate an increasingly interconnected and volatile global economy. The question is, how far will the U.S. go to protect its energy dominance? And can Canada use this moment to shift the balance of power in the global energy market? The world is watching.